There's a market worth $600 trillion that almost nobody understands. It nearly destroyed the global economy in 2008, and it is now 10 times bigger than it was then. Warren Buffett called derivatives financial weapons of mass destruction in 2003. He was right. They triggered the collapse of Lehman Brothers, the bailout of AIG, the near destruction of the entire banking system. The response to that crisis wasn't to eliminate derivatives or even reduce them. It was to make them bigger. Today, the derivatives market is worth more than 6 times the entire global economy. When it explodes, and it will explode, there won't be enough money in the world to bail it out. Most people have never heard of derivatives. Even professional investors struggle to explain them. But these complex financial instruments underpin every major bank, every pension fund, every insurance company, and every government bond market on Earth. They're supposed to reduce risk by allowing institutions to hedge against losses. In reality, they multiply risk by creating leverage on leverage on leverage. Bets stacked on top of bets until nobody actually knows who owes what to whom. And that's when the system collapses. In 2008, it required $29 trillion in global bailouts and guarantees to prevent total financial meltdown. The derivatives market then was about $60 trillion. Today, it's $600 trillion. When this bomb explodes, the blast radius will be global, immediate, and unstoppable. Let me show you why the next financial crisis won't be like 2008. It will be worse, much worse. To understand why derivatives are so dangerous, start with what they actually are. A derivative is a financial contract whose value is derived from an underlying asset. That sounds simple until you realize the underlying asset can be anything. A stock, a bond, a commodity, an interest rate, a currency exchange rate, even the weather or the likelihood of a company defaulting on its debt. The derivative doesn't require you to own the underlying asset. You're just betting on which direction it will move. It's like buying insurance on your neighbor's house burning down. You don't own the house, you just collect if it burns. That's a derivative. The most common types are futures, options, swaps, and forwards. A futures contract lets you bet on the price of oil, gold, or wheat at a future date without actually buying barrels of oil or bushels of wheat. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price. A swap is an agreement to exchange cash flows, like trading a fixed interest rate payment for a variable one. And forwards are customized contracts between two parties to buy or sell an asset at a future date for a predetermined price. Each of these can be useful for legitimate hedging. A farmer might use a futures contract to lock in the price of wheat before harvest, protecting against a price drop. An airline might use derivatives to hedge against rising oil prices. A corporation with debt in multiple currencies might use swaps to manage exchange rate risk. But the derivative market isn't dominated by farmers hedging wheat prices. It's dominated by banks making leveraged bets on interest rates, credit risk, and currency movements with borrowed money. And here's where it gets dangerous. The notional value of a derivative is the face value of the underlying asset. But the actual money at risk is usually much smaller. If a bank enters a $100 million interest rate swap, the notional value is $100 million. But the bank might only put up $1 million in collateral. That's 100 to 1 leverage. If the bet moves 1% against the bank, the collateral is wiped out. If it moves 2%, the bank owes money it doesn't have. Multiply that by thousands of contracts across dozens of banks, and you have a system where a small market movement can trigger cascading failures. The real problem is complexity. Modern derivatives are so complicated that even the people who create them can't fully predict how they'll behave under stress. Credit default swaps, one of the derivatives that destroyed the system in 2008, were supposed to provide insurance against bond defaults. In practice, they became side bets where investors who didn't even own bonds could gamble on whether those bonds would fail. AIG, the insurance giant, sold hundreds of billions of dollars worth of credit default swaps without setting aside enough capital to pay out if mortgages defaulted. When the housing market crashed, AIG owed more money than it had. The US government had to inject $180 billion to prevent AIG from collapsing and taking every major bank with it. But here's what makes derivatives truly terrifying. They create counterparty risk that spreads like a virus. If Bank A owes Bank B money on a derivative contract, and Bank A fails, Bank B doesn't get paid. Now Bank B can't pay Bank C, and Bank C can't pay Bank D. The failure of one institution cascades through the entire network in hours. That's what happened in 2008 when Lehman Brothers collapsed. Lehman had over $35 trillion in derivative contracts when it went bankrupt. Every institution that had traded with Lehman suddenly faced losses they hadn't anticipated. Some of those institutions couldn't absorb the losses and needed bailouts. Others survived but stopped trading with anyone they didn't absolutely trust, freezing the credit markets and turning a financial crisis into a global recession. The lesson from 2008 should have been to ban or severely limit derivatives, especially the most dangerous types like naked credit default swaps where you're betting on defaults of bonds you don't even own. Instead, the Dodd-Frank Act created some reporting requirements and moved some derivatives to central clearinghouses, but it didn't reduce the total size of the market. Banks argued that derivatives were essential for managing risk, that they provided liquidity, and that eliminating them would harm the economy. Regulators believed them or were too captured by industry lobbying to act. The result is that the derivatives market didn't shrink after 2008. It grew massively, from 60 trillion to over 600 trillion today. Let me show you what happened in 2008 when the market was only 60 trillion. Because understanding that crisis reveals exactly why 600 trillion is a civilizational threat. The crisis didn't start with derivatives. It started with subprime mortgages, loans to people who couldn't afford them, bundled into mortgage-backed securities and sold to investors. But derivatives are what turned a housing bubble into a global catastrophe. Banks didn't just hold mortgages. They created complex derivatives based on those mortgages, amplifying both the profits on the way up and the losses on the way down. Lehman Brothers was the fourth largest investment bank in America when it collapsed in September 2008. On its balance sheet, Lehman reported assets of $639 billion against liabilities of $613 billion, making it appear solvent. But buried in footnotes was the real danger. Lehman had over $35 trillion in notional derivative exposure. These weren't assets Lehman owned. They were bets Lehman had made with counterparties around the world. Most were interest rate swaps and credit derivatives tied to the mortgage market. When housing prices started falling in 2007, those derivatives started losing value.